Well, welcome again, everyone. This webinar is brought to you by the Small Business Succession Planning Program, part of the OEOC at Kent State University in Kent, Ohio. We're a nonprofit training and outreach organization located at Kent State. We do job retention and business growth by helping small business owners learn more about the importance of succession planning. Today we have Kip Krakowski of Confidential Business Sale, and the subject of our webinar is selling to an outside buyer and managing that process. So with that, Kip, it's all yours.
Good morning, everybody. As Jay mentioned, I'm Kip Krakowski of Confidential Business Sale, and today we're going to talk about selling to an outside buyer and managing the process. As you'll see, there's going to be a lot of information given to you here in the next, I'd say, 45 minutes or so with the presentation. And then in the Q&A. By no means is this all-encompassing of all that goes into selling the business, but I think it's going to be a good high-level overview with some additional details to kind of give you an overview as a business owner what you may entail if you did decide to sell your business. So with that, some of the topics that we're going to cover today, some critical questions that you need to ask yourself before you start this process. Some you may have thought of, some that you may not have thought of. Some of the difficulties when selling the business. A role of a business intermediary. Also the business selling process, which we're going to spend the majority of the time today talking about. Finishing up, we'll be talking about some of the different types of business buyers and what they're looking for, and some other discussion points, time pending. And finally, some question and answers. So with that, I'm going to jump into some critical questions that you should be asking yourself in this process. The first question to ask is, do I have a way to confidentially market my business without my current employees, customers, or suppliers knowing that I'm considering the sale of my business? And the reason you need to ask this is like selling no other asset that you ever sold before. Selling a car, selling a house, selling any other type of asset, you want the whole world to know that it's for sale so you can ultimately get the most interest in it and hopefully get the highest price for it. But when you're selling a business, you really don't want to create any turbulent waters with your employees or any of your other support like your suppliers or customers. And really, we work in this little underground world trying to work and try to find a potential buyer and ultimately get a deal completed. Just some facts in regards to a study that was completed by the M&A Source and International Business Brokers Association. After a survey was completed with business owners that used an intermediary, the results showed that 90% of business sellers felt that it resulted in a more confidential sales process. The second question you'd want to ask yourself is, do I have time to take away from running my business to handle the business sale process? And will my business potentially decline in revenue and profitability, which would make my business even more difficult to sell? And the reason I'd like to ask this question to business owners is they don't really understand what all goes into this business sale process and the time that's involved in making sure all the I's are dotted and the T's are crossed. And if many business owners, like myself, are very busy in the day-to-day activities putting out fires, just think of trying to add on another full-time job on top of that to try to manage the sales process. And the next slide here is a pretty interesting statistics, again from the International Business Brokers Association, that a study shows that actually less than 3% of buyers that inquire on an opportunity actually purchase a business. And if you think about that, for every 100 buyers that inquire, 97 of them are just tire kickers. So that's a lot of time that could be wasted with buyers that really aren't buyers. Third question you'd want to ask yourself is, do you know the way that, or excuse me, how do I know that I am not asking too much for my business, potentially scaring away buyer prospects and prolonging the time frame to sell, but not asking too much, leaving money on the table? And we'll talk a little bit further about business profitability and how that's viewed by a buyer. But this next slide has another interesting statistic that less than 25% of businesses with revenue under $10 million will sell. And that's often the result of being mispriced. And failure to do pre-sale planning is the #1 reason why deals fail. And again, those are some information from the Business Reference Guide that's compiled by Tom West annually, as well as a PricewaterhouseCoopers study that was done on business ownership. Question 4, do I have a way to market my business to the largest audience of potential buyers? As I mentioned before, that needs to be done in a confidential manner. Another survey revealed that 60% of sellers said that they received over 40% more for their business using a business intermediary. And it's often as a result of reaching a larger number of buyer prospects. And I'll discuss a little bit about how we go about finding potential buyers once we get into the more of the meat of the presentation. And the 5th question is, do I have a way to provide a buffer between me and the buyer prospect to address my concerns during negotiations and due diligence without jeopardizing the chemistry that I've developed with the prospect? As you can imagine with negotiations, there's a fine line of being cooperative as well as trying to get the most from your end of the deal. And sometimes having somebody in the middle being the punching bag can help you achieve that. And one more slide here in regards to facts. That survey showed that 90% of sellers using an intermediary felt that their involvement resulted in significantly reduced stress. And the reason I threw those 5 questions out there is really to illustrate what I do, I guess, on a daily basis, and that's work with business owners in this business sale process, and really explain some of the need on why somebody like us or somebody like myself could actually be a benefit to you. Yes, there is a cost, but it's basically an investment in your business to hopefully maximize your return. Some of the difficulties that sellers will encounter in this business sale process is valuing the business, not really knowing how much the business is worth. And there's over 65% of business owners don't have a clue on what their business is worth, and actually 85% of business owners don't even have a formal exit plan in place. Keeping the sale process confidential is a major concern with business owners. Also, trying to market this, structuring the deal, financing the deal, preparing documents, negotiating, really coordinating the timing of all these events, dealing with buyers, remaining objective in this process, and running your business and selling business. These are all problems that sellers typically encounter when they're trying to take this process on. With business owners that we deal with, 90% of the time we're dealing with first-time business sellers, and 90% of the time we're dealing with first-time buyers. So we're really holding the hand with both individuals through this process. And we're going to go through a number of steps here in this selling the business process, and you'll see there's a lot to it. But in all reality, we actually spend more time with business buyers because there's some additional factors that you're dealing with on the emotional side with business buyers and really need to help hold their hand through the process. One more slide before we get into the actual step-to-step process. The role of a business intermediary. Really, a business intermediary is there to serve to provide confidentiality. They're that buffer between you and a prospective buyer. Is that buyer out there just fishing for information, or is their true intent to potentially purchase? A business intermediary helps sort out those people. Really educates all the parties on the process. As I mentioned, most of the time we're dealing with first-time buyers and sellers. Really create a customized marketing package, and in the way that you present your business could be the difference in how much you actually get when the business is sold. And really work and execute that marketing plan to try to get the most confidential exposure out there. And as I mentioned, we wear a lot of hats in this process, and one of the hats that we do wear is that punching bag and provide that buffer. It's a very emotional process for business sellers. This is their baby. They've created a business, spent numerous hours, probably spent more time in this business, growing this business, than they did with their own family. I mean, that's just the reality of it. And so there's a special love that these business owners have for their business, and they want to make sure that it's being able to carry on with somebody who has that same type of love for the business. And from a buyer's end, basically there's a similar emotional issue that they're dealing with as well, because most of the time they're leaving a secure job. Many times we're dealing with mid-level managers that have been downsized or have decided to not work for the man anymore and want to own their own business. And that's a big jump and leap for them to go from receiving a paycheck every week or every 2 weeks to now all of a sudden have the risk of business ownership. I did see a question jump up here, and I'm going to try to address the question, and it was in regards to what percentage of businesses with over $10 million sell. And I do actually have an answer for that, and I'll address that one later on in the presentation once I can find that slide that's in front of me. But anyway, we can also provide that negotiation skill as far as being able to provide the different deal experience that we had when we completed other transactions, and really bridge the gap when a buyer and seller are close but not quite together on how much one's willing to pay and how much one's willing to accept. And we really facilitate that process from start to finish. So with that, I want to really dive into the meat of this presentation and probably the reason you decided to call in. As you see here, there's really 4 columns. There's the planning stage, the search stage, the deal-making stage, and the closing stage. And I believe there was a question on whether or not you can get a copy of this presentation. Yes, that you can get a copy of this presentation. So you may be squinting right now looking at this chart, but I'm going to go over this in much greater detail. The first step of the planning stage is the plan for selling. And that kind of begs the question is, why do business owners sell? And typically it's a human reason that causes the business sale, whether that's health, retirement, relocation, partnership issues, divorce. And actually the #1 reason why businesses sell is owner burnout and just very tired of the day-to-day grind. The unfortunate thing is many people put this off because they have that fear of the unknown on what it would be like without owning this business, or they're just stuck putting out the day-to-day fires, or others actually had that loss of identity feeling. It's like, okay, right now I'm the business owner and I belong to the golf club and people respect me. If all of a sudden I sell my business, I don't own anything, do I already all of a sudden have a loss of identity and people won't look up to me anymore? Those are some of the real-life concerns that we run into with business owners. So if you fall into one of those categories, you're not alone. The unfortunate thing is once they realize they're ready to sell, we often get a call. But the downside is many times business owners call us way too late in the process and really have an unrealistic expectation on the sales cycle, the time frame on a typical business sell. They figure it's like selling a house or selling a car, and that it could get sold tomorrow or in a few weeks, or even in a few months for that matter. I'm a realist, and giving business owners the true picture is what I believe is what makes sense. And the typical time frame is 6 to 18 months for a business to sell, and that's after it's been on the market. And that's really not counting the planning stage as well as the post-transition period where a buyer may want to keep you on board to potentially transition accounts over or make sure that there's really a smooth transition from owner, the current owner to the new buyer. And also, the more time frame that you have in working this process, that really allows you to maximize your value and minimize your taxes. And I look at that as really a multi-year planning process. And just as a side note, we actually added a subsidiary to our company to work with businesses over that period of time instead of just having business owners call us at that last second and performing the transaction stage. It often takes also time to potentially put the business on the market or even get to that stage where you're starting to dive into greater details. And that may be multiple meetings, making trips out to the business, meeting with the business owners, their spouse, and really making sure that they're comfortable with it being the right time to sell. So what I'm framing here is that this is not an overnight process, and it's going to take a period of time to make sure that you can really maximize the value of your business. Once you're ready and you realize that you're ready to pull the trigger and go through this process, the next stage is really gathering that data. And this is where we really spend a lot of time with the business owner trying to extract what type of value is in this business, not just from a financial perspective, but also the history and what they've created. Our business model is we have a 125-question questionnaire that we go out to business owners to really identify strengths and weaknesses, growth opportunities, any potential legal issues, insurance-type issues, lease issues, details of the real estate if they happen to own, facility-type information, a really detailed employee information, trying to figure out who the key employees are, what kind of salaries do they make, are they above the market, below the market, what kind of benefits they receive, the job functions that they actually perform, are there family members involved in the business, are they going to be involved after the sale, how's their turnover with employees, how's the owner's time split between the various job functions, trying to figure out what types of licenses are needed to perform the service of this business. What kind of history does it have? What are some of the selling points? I mean, how are the sales broken down, the products and services? What kind of geography you cover? Customer information, supplier information. Is there heavy concentration in one area or another? What kind of competition is there? Are there any industry changes or trends going one direction or another? What kind of structure is the business entity? What's involved in the sales and marketing? How is the business and sales obtained? Do they have a website? What kind of equipment's involved? How old is it? Is there a lot of inventory? Is it obsolete? As you can see, there's a lot of details in regards to gathering information to really make sure that the business is presented in the best light. And of course, so far I've mentioned a lot of things. I didn't even mention anything related to financial information. As far as financial information, buyers are typically looking for the last 3 to 5 years worth of income statements and balance sheets, as well as tax returns, and also year-to-date information, year-to-date income statements, and a current balance sheet. As you can see, there's a lot of information gathering involved in this process, and really what all that information is used to do is to try to figure out, okay, how much is this business potentially worth? What's the market value? How much could you actually go out and try to find a buyer for to purchase this business? The next stage in this process is called recasting of the financial statements, and this is foreign to some people, and some people will get this. Really, small business, as you probably know, is very different from big business. Public companies are out there to try to show how much money they're making so they'll get investors. Small businesses, on the other hand, the only people that typically see the tax returns are the business owner, their accountant, and the IRS. And so there's a little bit different goal of a business owner versus a public company, a small business owner versus a public company. The typical goal of a small business owner is to really minimize their taxes but maximize their lifestyle out of the business. And business owners do that in a number of ways, especially expensing various perks or things through the business, whether it's a a company car. You know, all of a sudden a guy owns a florist shop. Yeah, maybe he has a delivery van, but does he really also need a Mercedes? And so, but the Mercedes happens to be expensed through the business. Some things are legitimate, some things are borderline, some things are definitely not legitimate that we run across. But that being said, those things need to be extracted to figure out what the true earnings are of that business. And that's what we actually call discretionary expenses, or seller's discretionary earnings. And the term of trying to go through that process to recast the financials or adjust or normalize the financials is really a critical step in this process for a small business, because the whole idea here is to convey to a business buyer, how much money could I make by buying your business? At the end of the day, that's why somebody's going to buy a business, and why they're going to pay X number of dollars for it, is to provide themselves a living and also get a return on their investment. If they can't do that, they're not going to buy your business. And so the International Business Brokers Association defines that seller's discretionary earnings term, or cash flow, as you may see it in different pieces of literature. It's basically the earnings of a business enterprise prior to the following expense items: income taxes, non-recurring income and expenses, non-operating income and expenses, depreciation and amortization, and interest expense or income. Sometimes these are positive, sometimes these are negative, and you need to adjust them to show the actual picture for a new buyer coming into this business. A very important step to this process, in whether you're calculating a seller's discretionary earnings, or if we happen to have business owners that have a little bit larger business, typically when you get over into businesses, I'd say $5 million in revenue and north, all of a sudden the term changes over to EBITDA, and that's earnings before interest, taxes, depreciation, and amortization. And then a different buyer pool all of a sudden starts to get interested in your business if you get over that plateau. And that's where private equity groups or some strategic buyers may be interested in buying your business. But they're typically looking for $2 million in EBITDA or higher. Otherwise, you're probably dealing with an individual buyer. The next step is basically determining the value of the assets to be sold. And that's really going through a formal business valuation process. And we recommend that a third party does that, just because it's an unbiased look at how much the business is really worth and how much it could be marketed at, if you decide to use a price to market your business. There's really three main categories or methods of doing a business valuation. There's the asset approach, and the market approach, and the income approach. The asset approach is basically looking at the fair market value of your equipment and inventory. The market approach is looking at comparable sales, and the unfortunate thing is no small business is identical to another small business, just because there's different customer bases, different locations, different histories, different employees, and so on. And then there's the income approach, and that's more of a mathematical approach, looking at the profitability or the cash flow. And there's various ways that you can calculate using the income approach: discounted cash flows, capitalization of earnings, and there's even more methods than that, but those are two common ways. But they're looking at it from a return on investment standpoint, and how much is there enough profit to service the debt on this business. It's a little bit of an art to do business valuation, and it's really not as simple as just taking a multiple. A lot of times I'll run into business owners that will say, yeah, my friend at the golf club got a 10 times multiple or a 4 times multiple of earnings on his business. And I always scratch my head and say, well, that's fine. I could possibly get you that as well, but let me choose the earnings base. And let me just illustrate what I'm saying here is I'm going to use a small business, for example, that sells for $600,000. It may happen to have $200,000 seller's discretionary earnings. The same business would have possibly $150,000 EBITDA, and also it may have $100,000 of net income. This is the same business, but if you look at those various categories, they have different numbers calculated for them. If you look at the $200,000 seller's discretionary earnings, that's actually a 3 times multiple if it's sold for $600,000. If it had $150,000 in EBITDA, that's actually a 4 times multiple. If it had $100,000 in net income, that's actually a 6 times multiple. And the problem that we run into is a lot of times people aren't talking apples to apples. And so they're just throwing these multiples out there because and they want to sound knowledgeable, but a lot of times they really don't understand what that is a multiple of. And very important when you start to look at business valuation to make sure that you're talking apples to apples. So once you do have a value on your business, the question is, well, does it make sense to sell now, or possibly keep the business and grow it to that point where you want to sell it? I have one question that came up is EBITDA, if for a definition in that, and that's really earnings before interest, taxes, depreciation, and amortization. And the best way of looking at EBITDA versus seller's discretionary earnings is really seller's discretionary earnings is looked at as an owner-operator. So if I bought your business and I'm going to work full-time in this business, how much money would I have at my disposal to pay myself a salary as well as service any debt that I may have, or keep the profits in the business? On an EBITDA standpoint, a little bit different in the sense that it's from an investment standpoint. So like a private equity group, they're going to have to go and put a full-time manager or a CEO or president into that company to run that business. And so they're looking at that as an expense. And so once that expense is in there, how much money is left over? And that's really your EBITDA number versus your seller's discretionary earnings. So EBITDA is smaller than seller's discretionary earnings. Hence, you typically have higher multiples for EBITDA versus seller's discretionary earnings multiples. Hopefully I didn't confuse you there, but that's the difference between the two. So once you've decided on whether or not to sell or keep and grow your business, assuming that you decide to go the process and sell, the next stage in the process is preparing a confidential business review. And I also always like to use a little more common terms for it. I call it our detailed profile because basically that's what it is. It's a more in-depth profile on your business that you would want to share with a business buyer to get them excited. These typically run anywhere from 5 to 10 pages. They could be a little bit longer for a little bit larger business, but in majority of them, 5 to 10 pages will be sufficient. And this is taking a lot of that information that was gathered in that gathering your data stage, step 2, and just put it in a Word format to where it's in a salesy presentation type marketing piece that will get a buyer excited. And so it'll have history, details, highlights, opportunities, possibly some pictures, high-level financial information, asset lists, and so on. And really this information is only shared with a buyer prospect after they've signed a confidentiality agreement or a non-disclosure agreement. And I'll explain that here in a few minutes. The other marketing piece that's put together is called a public profile, and that's kind of the teaser. And that's basically a short summary of your business without being very specific on your location or exactly what you do, because you don't want your competition knowing that you're for sale or your employees getting concerned that they may not have a job tomorrow. So the key is being very discreet on how the business is marketed. And a perfect example of this is we had sold the second largest apple cider producer in the state of Ohio. And so you can just imagine in a niche industry like that, at their level of sales, if we've said that this business is in Northeast Ohio or even Ohio for that matter, and said that their sales levels were X number of dollars and they produced apple cider, it would have been a dead giveaway to their competition and their customers and their employees that they were for sale. And so we had to be very discreet on the way that we marketed that business. And we ended up saying that they were a beverage manufacturer located in the Midwest. So that didn't define that they were apple cider and didn't show that they were in Ohio or Northeast Ohio. And it was vague enough to get interest. And then once there was interest, we were able to share some additional information after a non-disclosure was completed. On the flip side, let's go to the other extreme where it may be a common business like a pizza shop. Well, if I said, I had a pizza shop in Cleveland, well, there's probably hundreds of pizza shops in Cleveland, so you may want to be more specific, saying you're a pizza shop located on, the east side of Cleveland or eastern Cuyahoga County, or being a little bit more specific for your buyers, because most of the time those types of buyers are going to be more of a local person that would travel to the business versus a larger company trying to purchase the opportunity that could be out of state. And with these blind or public profiles, what we do is we actually review these with a business owner prior to putting them on the market. And the reason for that is just to make sure that the business owner is comfortable in the way that it's being presented and don't feel that it's too descriptive to where it would pinpoint them. So once all this marketing material is pulled together, the next couple steps in the process is really the buyer search plan. And that's figuring out how are we going to market this business. Personally, what we do is we market on a number of business for sale websites, actually over 13 of them, everything from like Entrepreneur Magazine, Inc., Biz Buy Sell, and there's a number of websites out there. But what these do are very specific websites for people who are looking to buy businesses to go out there and search. And they can search by location, by industry type, and they can do it 24/7. We get inquiries, all night and all over the weekend on business opportunities, whether it's somebody that's all of a sudden been downsized or they had a bad day at work. They're out there looking for business opportunities or other companies that are looking to expand. The other thing that we do is we have an active database of buyers that have contacted us, and so we actually send out a monthly email to over 6,000 buyers. And what we have found is 9 times out of 10 on businesses where individuals purchase the businesses, 9 times out of 10 they actually buy a different business than they initially inquired on. And it's really just staying in front of business owners or potential business owners and letting them know what opportunities are available to them. And after we learn a little bit more on what they're looking for as far as their location, the type of business, and so on, we end up being able to match them up with a different opportunity over time. And also we have basically 3 offices, and so each individual in our office has their own individual network, professionals and other buyers that they've worked with, and they're able to match them up. One of the other things that we do is we work with a business owner to try to figure out whether or not to talk to potential competitors or customers. Do you want us to pursue them at a certain time? And there's pros and cons of approaching them right away or waiting later in the process to do so. And so that is really on a case-by-case situation to work with a business owner to figure out what is the best buyer search and marketing plan for that specific business. The next step in the process is the qualifying of the buyer. And this is really where an intermediary can come in handy, because they can be that buffer. They will require that a non-disclosure and confidentiality agreement is completed by each buyer for each business. And what this does, it basically provides a tracking device to show who saw the business and on what date did they see the business or the business information about the sale. In addition, this document requires them to complete a net worth and liquid funds part of the document to show how much money they truly have to purchase this business. So if they only have very little funds available to purchase a business, does it make sense to actually show this business to them? And if they don't, then the answer is no. If they do have enough money, then of course you want to share the information about the sale. And as we mentioned earlier, 97% of buyers don't purchase a business. And the reason for that is there's many tire kickers out there that aren't financially qualified or don't have the true intent to purchase the business. And really a business intermediary can provide that buffer and sort through those individuals. The other thing is mentioned on the early slides, you really have time to sort through these tire kickers as you're trying to run the business. And it can be very time consuming because buyers really tend to waste time, unfortunately. However, they're a necessity of the process because you need a buyer to purchase the business. What we also do as part of the qualification process is local buyers that are within an hour of the office, have them come in to the office so we can see them face to face. And this is a way to get to better understand what they're all about, what they're looking for, and show that they're for real. So if they're within an hour, they come in, meet with us, and it shows that they're serious. The next stage in the process, once they've completed that confidentiality agreement, and that's really presenting them with that CBR, that confidential business review. So if they qualify, they'll get some additional information, and hopefully that's going to get them excited about taking the next step in the process. If it's a business where they can go buy as a confidential customer, we encourage that. And that's a way for them to go and see the business firsthand without talking to any employees and seeing if it's up their alley or not. If they don't like the location, don't like the service or whatever it is, and it's something that they feel that they cannot change, then it doesn't really make sense to go to the next step. Some businesses you don't have that luxury with manufacturing or some distribution companies where you really can't walk in as a confidential customer. And so you really have to jump to that next stage, and that's really the buyer-seller meeting. And this is probably the most important step of the process from a buyer standpoint, because I tell them to come and ask questions. Don't be shy. It's their chance to really find out on whether or not it makes sense to continue pursuing this business or not. Because a lot of money and time can be wasted if it's not the right opportunity. So I tell them to come and ask questions. And from a seller's perspective, it's your time to shine. And this is where you need to be honest, personable, answer questions. And it really needs to be some chemistry developed between the buyer and seller if they're ever going to get to the closing table. Our role in this process is really to facilitate the meeting, introducing one another up front, and then from there it's a lot of questions and answers. And to be honest with you, most of the best meetings that we have is where I say very little other than maybe making sure that some of the selling points are brought up. So hopefully there's good conversations between both the buyer and seller. Hopefully after that meeting they've got all their questions answered and they show that they've got true intent to continue on. What we do is encourage them to present an offer to purchase or a letter of intent on the business. And we encourage buyers to do this much earlier in the process than later. And that's really because intense due diligence can really cost a lot of money and a lot of time. And if the buyer and seller are miles apart as far as how much one's willing to pay and how much one's willing to accept, then there's really no reason to spend and waste all that time and money involved in that. So an offer is really a start. And as I mentioned earlier, we serve that role as a punching bag. We remove the emotions from it. And when you're dealing with those first-time buyers and first-time sellers, a lot of times they'll take these offers personally. And what we do is we bring that sanity to the situation to where we can allow everybody to take a step back, think through everything, and come back with a counter proposal. Also, we can come up with ideas as far as deal structuring to make the deal work, whether it's coming up with a certain amount of cash, seller financing, if banks are going to be involved, maybe earnouts. There's various ways of structuring a deal that can help pull the two parties together. And it's not just price, it's terms. For example, a business could be worth $1 million. And I could be willing to pay $3 million. But that $3 million I'm going to pay in 20 years from now. So that gives you an illustration that price is not always the determining factor. It's how are you going to get paid, when you're going to get paid for the business, and how difficult it's going to be to get the deal done. Are banks going to be involved? If the answer is yes, in today's lending environment, it's going to take a heck of a lot longer to get the deal done if it ever goes through. So what we do as an intermediary is we know a lot of the things, how the banks are financing, what they're looking at, and we help address some of those smaller issues that come up in the middle of negotiations. Assuming that there's an agreed upon price and term for the business, then basically the due diligence period begins. And that's where really a quarterback needs to be involved, making sure all the communication is going back and forth between buyers and sellers and their professional advisors. And so you may have a lot of individuals that are involved in this process. A buyer is probably going to have an accountant, their attorney. They may also have a lender involved. The seller probably has their accountant, their attorney. They have a landlord. If it's a distressed sell, they may also have their lender involved or a turnaround specialist involved. And as you can see, all of a sudden you start to count, you're on two hands with the number of professionals that are involved. And so somebody really needs to make sure that somebody's coordinating all the communication going back and forth. As a business owner, you really need to be prepared that there's going to be a lot of questions asked, and you're going to need to pool a lot of information together. And I can't stress that enough, because many business owners are like, they just can't believe on how much information is needed to convince a buyer to proceed with purchasing this or not. And so as a quarterback, we kind of help make sure that items are addressed and timelines are met, and come up with solutions, because there will be issues that come up. And I'll stress that again, that there will be things that come up that were not anticipated. So there's really small little negotiations that occur from the accepted offer or accepted letter of intent all the way through closing. Typically one side or the other is going to have an attorney draft the purchase agreement, and then they're going to have the other attorney on the other side review it. And so that'll go back and forth a number of times to get the wording acceptable to both sides. There's usually also a bill of sale. There could be a seller financing, like a promissory note. The attorney may be doing a lien search on some of the assets. And so that takes time as well. Also, if a lender is going to be involved, they're going to look for a loan, a loan package, and it's going to involve a business plan and projections to be pulled together. Personal information. Really a lot of information. They may require a business valuation if it's an SBA loan, currently over $350,000 in the amount that's going to be loaned. They may require equipment appraisals for collateral, or even real estate appraisals if it's part of the transaction. Environmental studies. The list can go on all the different things that could be required to get to the closing tables. And in all reality, from the time that you get an accepted offer or letter of intent, it could be 60 to 90 business days. And so it's a very long process, especially when banks are involved. And the critical thing to keep in mind is you need to keep running your business assuming that you're going to get to the that you may not get to the closing table, and that the business may not sell. The first year that I was in this business, we had a deal blow up at the closing table, and this was unexpected, because all of a sudden the buyer's wife freaked out when the bank said that she had to sign personally on the loan documents. This was not foreseen by anyone. And the unfortunate thing is the seller thought that his business was sold, and so he saved money towards the end, thinking that the deal was already closed, and he didn't submit his Yellow Page advertising. And anybody that uses Yellow Pages, and I mean, Yellow Pages aren't as important today as they used to be, but at that time in his business, it was very important. He didn't submit the Yellow Page ad, the business didn't sell, so now all of a sudden he has the business without his Yellow Page ad, and because of that his sales dropped. And if you just think on and on, well, if, okay, next year your sales drop, a buyer looks at this business and says, okay, last year you did X, now you did less than that this past year. Why? Yeah, you're telling me it's Yellow Pages. Is it something else, though? And so then it basically took another year to show that there was growth after he put the Yellow Pages back in, and that the business turned around. So now all of a sudden, and the time frame to sell was extended by a couple years. I mean, that's an extreme case, but that's the reality of it. You need to be thinking that a business will not close. So until the fat lady sings, keep running your business as normal. Assuming that your business does get to the closing table and it actually closes, there's typically a training and transition period, and this can range anywhere from 2 weeks to a year, possibly more depending on the situation, the complexity of the business, and in the buyer that's purchasing it. Sometimes there's also phone consultation. And it's really important to know that there is usually a period of transition that's required. And that's important especially if there's seller financing involved. You want to make sure that you actually get paid back for the money that you are loaning to this prospective buyer. On the next slide, we're going to talk quickly about the different types of buyers, and we've mentioned high net worth individuals. These are many times the mid-level managers, as I mentioned, that have been downsized or all of a sudden want to work for themselves, and they're looking for various types of businesses because they see an advantage of buying an existing business versus starting one from scratch. It's already up and running. The risk and uncertainty may already be reduced since they can have some history to look at. There's also an infrastructure in place, everything from an established location, established customers and reputation, employees, vendors, policies and procedures in place. There's some cash flow coming in at day one. There really isn't that startup period, so it's quicker to profitability. And a lot of times it's easier to obtain financing on buying an existing business versus starting one from scratch. But as with a high net worth individual, many times they're first-time buyers, and so you're dealing with situations where you're dealing with the emotions. And so they're not looking at it from a strictly financial perspective. All the buyer jitters come into play, or all the different family members talking into their ear, letting them know how crazy they are leaving their job and so on. So that's one thing you need to consider if you're selling to individual buyers. Private equity groups are only really interested in those larger transactions, typically over $2 million in EBITDA. And so again, they're looking at it from a financial perspective, and they need to see a strategic, either the types of businesses that they have in their current portfolio or management that they could put in place to your business. Then there's also industry buyers, and these are those strategic type buyers where they may see a fit for your business. And for example, we sold an aluminum fabrication business and was basically breaking even to a steel fabricator. The steel fabricator had space in their facility. They already had a sales infrastructure in place. So basically they picked up these machines from the one location, put them in the other location, added product lines. They already had employees that could really cover that work. Now all of a sudden you turned a break-even business into a profitable business, and that's an example of an industry-type buyer that may see some synergies of purchasing a business opportunity. So what are things that buyers are looking for? Ultimately, they're looking for cash flow. They need to see that you're making money, or that by buying your business, they can make money by making some of those changes, such as the example I just mentioned in this the strategic or industry buyer situation. They're looking for a diverse customer base, growth potential. I mean, they're paying for the past, but they're buying for the future. That's really what buyers are doing. And typically, they're looking for a business owner that's willing and able to transition this period over a 1 to 6 month time period, or possibly more. Reasonably priced, flexible terms, and if it is an individual buyer, they're looking for a living wage. They need to make sure that they're able to make a living as well as service the debt. Some other quick discussion points that I'm just going to mention here real quick before we open it up to the questions and answering. Financing, it's definitely changed over the past year and a half, 2 years. It's not as easy to get bank financing, and that typically means that seller financing is a larger requirement or larger percentage of the deal transaction than it was in the past. Deal structuring, very important. Using a business intermediary, they can possibly make an unsellable business to the common person sellable by structuring it various ways. Network advisors, really important to make sure that you use professionals in selling your business. It's not the time to really go the cheap route to try to save a couple dollars, because many times the business is the most important or highest value asset for a business owner. Studies show that 90% of a business owner's net worth is tied up in their business. And experiences, that's something when you're evaluating your professional advisors, to make sure they have experiences in selling small businesses. Whether it's an attorney, make sure that they have history of doing business purchase agreement contracts. You don't want really an inexperienced attorney to be guiding you through this process. Same with accountants. You want to make sure that they're familiar with small businesses versus just big businesses, because of a lot of the creative accounting that occurs in small businesses. And same with business intermediaries. You want to make sure that they've got a familiarity with this process, as well as potentially your type of industry. I can't stress enough how much experience can really come into play, and it may be the difference on whether or not a deal gets completed or not. With that, I want to go over to the question and answer session, but I want to come back. There was one question that came up, the what percentages of businesses with over $10 million in sales actually sell. And to answer that question, businesses over $10 million in revenue, they make up actually only 3% of the businesses that are out there. So 97% of the businesses are less than $10 million in sales. But the ones that are over $10 million, there's a category of $10 million to $50 million. 50% of those businesses sell. And then once you get to over the $50 million barrier, almost 100% of those businesses sell. So really what that's saying is, the larger your business, usually there's a buyer out there. Now the question is at what price, but usually there's somebody, a synergistic person, that will ultimately come in and can fold the business into it. But a lot of times it ends up being a creative deal to where the seller ends up having to seller finance a pretty large portion of that deal. Or there could be some other different capital sources that come in. But the smaller the business, the higher percent that it isn't going to sell. And most of the time that's because there's not as much. The business is the individual. If you think about a small consulting business, a lot of times the business is that person, that is that consultant. And let me see, was there another question, Jay, out here?
Yes, one from Paul. Did you see that one, Kip?
Let's see, where in the 6 to 18 month timeline of the sales does the that can really vary. The question is, where in the 6 to 18 month timeline of the sale does the letter of intent typically occur? It really depends on the business, and I know this is really an open-ended answer, but it's the truth. We've had a situation where we sold a metal stamping company that we had an accepted letter of intent a week after we put the business on the market. That's very, very, very abnormal, but we had a buyer that we knew had that background, that experience. He was an individual, but he was the head of a metal stamping company. Once that opportunity came in, he knew right away that he needed to act upon it, and he did, and it was at price and terms that were acceptable to the seller. Many times it takes longer, and you're looking at your year time frame potentially, but a lot of times that's a function of a number of things. How properly priced the business is there a lot of interest in that industry? For example, like medical is a lot more of a sexy industry right now versus maybe typewriter repairs. I'm just throwing that out there, but typewriter repairs, that's a dead business, or a dying business if it even still exists. So it really depends on a lot of factors, and also financing. What we found is over the past year and a half, banks have basically just shut off lending, and it's really created a much different scenario to where sellers have had to seller finance more of our deals if they wanted to actually sell or if it would go through the bank, it just takes longer because banks are very risk adverse, and so they're requiring all this additional documentation to be completed that wasn't required in the past, and that's really extending the timeline. Looks like there's another question is, what is the cost associated with selling? Business intermediary fees, legal fees, accounting fees, valuation fees. It's a good question. I'll kind of give you some ranges, I guess. From the business intermediary fees, depending on the most common structure is what's called the double layman formula, and that's where it's 10% on the first million, and then it's 8% on the next million, and 6%, and so on. So it's basically like a scale that goes down. Once you start getting up, and that's for, I would say, your businesses that are under $5 million, $10 million in revenue and under. When you start getting up into your really large businesses, the structure is a little bit different, and it needs to really be quoted on an individual basis. But that most of the time it's the double layman formula on your smaller businesses, that 10-8-6 type scenario, in reducing as this business gets larger. As far as legal fees, that's really all over the board. Depending on your situation, the size of your business, as well as the attorney that you select. If you get one of the top name law firms, they're going to obviously probably charge you more than maybe your local guy. But then again, are you getting the same service? I've seen things everywhere from, on the low side, probably $1,000 on legal expense to put together a purchase agreement, all the way up to could be $15,000, $25,000 on the legal side. So and really everything in between. Accounting fees very similar depending on what level of service that you're going to need. If it's your current accountant and you're selling, and he's already does your income statements and your tax returns, it may be very minimal. But if you got a buyer that's asking for a lot further breakdown of various things, and that's something that you typically don't prepare, then obviously you're going to end up spending more money on pulling together some of that information. And that's really why I stressed earlier on that it's more important to have that letter of intent earlier in the process to make sure that both buyer and seller are agreeing on the price and terms, realizing, there's going to be some small little negotiations between then and closing, but at least the general terms are agreed upon, so it makes sense to start spending that money if that's a document that needs to be created during your due diligence time period. Valuation fees, again, that can also vary, but depends on the level of valuation that you're needing. If it's just a valuation to price the business for sale, and it's a smaller business that doesn't have a ton of divisions or anything like that, it could be done possibly as low as maybe $1,500 up to $10,000, maybe a rough gauge for a more expensive, more in-depth business valuation.
A caution there, I believe you'd agree with Kip, is that on the valuation, get competent valuator. That's a critical part of this whole process, and make sure the valuator is qualified in that area.
I agree with you, and you especially want to use a third-party business valuator, not necessarily your accountant. Nothing against, there may be some accountants online. Certifications are required. You want to make sure that they're a qualified business appraiser, and there's a number of certifications out there, and if you're interested, I've got a list of things to look for. But the key is, like you said, competent. You want to make sure that this is what they do on a regular basis. They're not your accountant, because unfortunately, if they are your accountant, that's a biased opinion. And you'd be surprised at some of the valuations I've seen done internally by their own accountant, and then looking at it versus what the reality is. And some of them just don't make mathematical sense. And they're really doing a disservice for the client in a situation like that. So I recommend a third party because it's an unbiased view on how much the business is worth.
Well, Kip, we're just over 1 hour. I think you've done a fabulous job of highlighting the process for us, which is a complicated one. I'd like to unmute all now.
The conference has been unmuted.
So I've opened up the phone lines. If anyone has a question they would like to pose, let's do that now. Rich Bronson had in a chat earlier. I want to make sure that he's satisfied with the answer. With an owner that's not necessarily planning to sell but gets an offer from the outside. Rich, do you want to further follow up on that?
Thanks. Is that Kip?
That was Jay, but I found your question here, and yeah, your question about possibly using a business intermediary in a situation where you may be thinking of selling or get an offer, and how do you value your business? Those are things that you know, are almost like a la carte services that some intermediaries will do. We do look at certain situations like that. You know, if you do have a specific situation, I'd be more than happy to talk to you offline. But there's business valuations that could be done. Also, there is a value of bringing a business intermediary in a situation, even when maybe you've you know, informally run into a potential buyer. There's still things as part of that negotiation that you may want to get addressed that may be difficult if you're doing a face-to-face or even a back-and-forth communication by email. By having that buffer there, you can make sure that things are being addressed in a way that maybe the emotional side pieces are getting absorbed before upsets one part or the other and has the deal go south on you. So those are things that we do get involved with.
I guess, Kip, what I was concerned with, and maybe you've had experience with this, maybe not, using the buffer when the potential buyer has come directly to the owner, and then the owner says, you got to deal with this third party.
Trying to put us in the middle. Well, that can be done in a way that you know, you can say, well, I'm busy, you know, basically running my business, and I've hired this third party to manage this process, since this is something I've never done before, and all of a sudden, you know, now you can just direct all the communication to us. And that's one thing that's really an important piece that I didn't mention in this presentation, is communication between buyer and seller is best done through a business intermediary, just from the sense that, imagine if, you know, everybody's on email, of course, and if you run into a situation where you've written or received an email and the intent wasn't for it to come across a certain way, but after you read it, it comes across a different way, and all of a sudden you get somebody either upset or, and those are things that can all of a sudden just turn things and head them the other direction. Because you know, so a perfect example is we sold this $1 million business that all of a sudden the buyer and seller kind of just dug their heels into the ground, saying they weren't going to budge on this deal any further. And it ended up becoming that the buyer was so adamant that he wanted a go-kart, which, you know, has a value maybe, I don't know, $150. This is $1 million business transaction. And I ended up spending about a day and a half, probably, I don't know, maybe three and a half hours dealing with this business buyer and seller, going back and forth on a go-kart. And people do some strange things at strange times because of the fear of the unknown. It wasn't really the go-kart that was the main issue, but at that period of time, it was the go-kart. And so that buffer can help, like I mentioned, bring some sanity. So it's going back to each party saying, yeah, look, it's, you know, it's a go-kart for for Pete's sake. But it's trying to figure out what's the true issue here, and does it make sense to kill a deal over one issue or another.
Good. That makes sense. Thanks.
Do we have any other questions? Well, I have a quick one for you, Kip. Do you see a typical issue or two that commonly pop out of the woodwork that can be improved or changed to maximize the value of a small business? What I have in mind is the lack of adequate management succession, for example. I'm sure if that management line of succession isn't in place, the value of that business is degraded.
I agree. That's definitely one. You know, cross-training your employees, most of the time, small business owners, the wealth of knowledge is in that business owner's head. So making sure that gets transferred to a business buyer is very important, whether it's a person that's a current employee or somehow goes to that buyer. So developing employee manuals, cross-training your employees, really making sure that the information is written down. Simple things can cause headaches for buyers. And I'm glad you mentioned that question. It's out on our website. I have a list that you can obtain. You just need to fill out a form. It's 50 things to consider when planning to sell your business. And they're just simple one-liners, and some of them are obvious and some of them are not necessarily obvious, but they're different things that you can do to help maximize the value of your business and also reduce the number of headaches that you have. And it's really, it may lead to going and trying to find additional information, or if you go out, we have a blog that goes into some greater detail on a number of these items. But it could be solidifying your workforce, possibly putting some retainer things in place to incentivize a key employee to stay on after sale. Going back to that apple cider producer, and what was interesting on that business sale was when we initially put that business on the market, one of the big selling points was that there was a key employee that had been there for a number of years, and since it's a seasonal business, he knew all the business pieces inside and out, from taking care of the apple trees to knowing how to start up the pasteurizing presses and machines and all the presses and everything from season to season, shutting things down. Well, all of a sudden that employee, middle of the sales process, he didn't of course know that the business was up for sale, but he held the business owners hostage on wanting more money, wanting a higher salary. And so the business owner and I consulted back and forth, and we had to figure out that it makes sense to pay this person a higher salary or let them go and bring somebody else in. In that situation, we decided to let that person go and called his bluff and ended up bringing a new person in. So what was once one of the big selling points, we ended up having to shift everything and bring in a new employee. And our fear was if we kept that employee and paid him a higher amount, that business buyer all of a sudden buys his business, whatever time, 6 months later or so, that employee will probably hold that business buyer hostage as well. And we realized that was something that we couldn't afford, so it's better to send that employee on now versus waiting for it to happen later.
I would have done the opposite.
Well, we ended up selling it, so it worked out for us. Well, the business sellers also wanted to relocate from Ohio all the way out to Minnesota. That was their dream to purchase like a little resort out there, a campground on one of the lakes. And so they realized that they wouldn't have the ability to come back and all of a sudden train a new, if all of a sudden that employee left right at the time of the sale or after the sale, they didn't want to have to come back and try to train the new business owner on all these things, and felt it was easier to start training somebody now versus later. So it all worked out.
Great, Kip. Any other questions? Well, I think it's time to close off this session. I want to thank Kip again for presenting. You have his contact information on the screen in front of you. I want to thank you all for attending, and don't hesitate to contact Kip or the OEOC for further information on this subject. As a reminder, we will archive this session for future viewing, so please see our website for access to other webinars and podcasts. Our website, oeockent.org. Be aware of future events. We will be presenting a number of webinars coming up in the following weeks. In fact, on Thursday, the 7th of this month, where the business plan and strategic plan and succession plan all meet with Jim Awesome of Kavich, Famillo, and Durkin. On January 19th, Employee Ownership Sustainability, we're with Jim Steicher of SCS Advisors. On January 21st, Selling to Managers and Key Persons, Dave Gustafson of Apple Growth Partners, and you can check other webinars on our website. So again, I want to thank you. You will receive an email feedback form after this session, please give us some input so we can provide future subjects you need and improve our presentations. Again, thank you.
Thank you.
Thank you. Please